Neighbor to Neighbor. My name is Lynn Corum. I'm your host today. And today my guest is Steve Jones. Steve, welcome and thanks for joining us.
Hey Lynn, thanks for having me.
Steve, you're an accountant here in town, but before we get into that, I would like you to tell us a little bit about yourself, how long you've been in town, where your office is, that kind of, your interest in life, that kind of stuff.
All right, I grew up in Putney, Vermont. My grandparents, great-grandparents were all from Putney. I attended the Putney and Brattleboro Public Schools, went to college just outside of Boston, and right after college I came back to Vermont to enjoy the outdoors and the Four Seasons. And
came back home.
Came back home, yep.
Yeah.
I enjoy skiing, biking, racquetball, the softball in the summer. So enjoy the outdoors.
So this area offers a lot of that stuff very easily.
Yeah, I love the area.
That's what I like about it, you know. It's so easy to get to places, and you don't have to wait in line,
Right.
and you don't have to deal with traffic, and those are really big pluses. And you notice them when you go someplace else.
It is. So I obviously went to school for accounting in college, and came back to Vermont. I worked for Stowe Mills for a while when I got back, and then for an accountant, Jack Laxo, for about 10 years. And this past November, I opened a firm of my own with a colleague. So it's Keenan Jones.
Keenan Jones, and you're on what street in town?
It's on Williston Street.
Williston Street?
Yeah.
And they just got paved, so no one can say they...
It used to be a really slow, bumpy road. Now
Yeah.
it's a pretty quick road.
Yeah, good. I'd like to... taxes is your specialty, and taxes are a big item all the time, not just in April, but people are thinking about taxes all the time. So let's talk about the different kinds of taxes. We have income, FICA, capital gains, inheritance tax. There's probably more out there. So income tax is what?
Income tax is what everyone sees. They get nervous about it either April 15th, or a lot of people file extensions till October 15th. And it's made up, when you file your income tax, you might file and pay a couple different taxes. There's the income tax, the regular income tax.
On your work.
On your work, but it could also, there could be a component of alternative minimum tax within that. It's a different calculation. There's capital gains tax, which is on either qualified dividends or when you sell appreciated property.
So, or dividends you get, to any income, interest from the bank, if you had a lot of money in the bank, and that's income
Right.
that year?
You pay tax on any interest from the bank. That's taxed at regular income tax rates. There was capital gains, or actually you pay capital gains tax on qualified dividends.
Are they is capital gains at a different rate, or
Right.
does your income dictate that rate?
Both.
Both.
It also is a progressive tax that the capital gains rate in general is 15%. But if your income is low enough, it could be taxed at 5%, and actually in 2008 that 5% rate is 0. So if you...
Is that a new thing that's been in the tax code, that idea?
For 2008, I think it's actually 2008 through 2010, but it used to be a 5 and a 15% tax rate, and now anyone that's in the regular income tax rate of 15%, you actually pay 0% of for your capital gains rate. That would be when you sell appreciated property, or if you have qualified dividends.
So if I sold a house that I'd had for a number of years and sold a piece of property, the gain on that is considered income, or a capital gain.
Right.
And depending on my income, it depends how much you pay.
Let's stay away from a house that you live in.
Right. No, this is investment
But if
property.
you own an investment property, that gain from what you originally purchased it for, up to the point that you sold it at, that difference is going to be a capital gain. So if you were making $30,000 a year and sold an appreciated property for $200,000,
and you made $50,000.
and you made $50,000, a portion of that $50,000, well, the whole $50,000 is going to be capital gain, and a portion of that will be taxed in 2008 at 0%.
38% of all taxpayers do pay no income tax.
Okay.
This is a national figure that I've gotten out of the Wall Street Journal.
Yep.
But people say, I pay plenty of tax. But what are they really paying? They're paying FICA.
Right.
So what is the difference there?
But when you're a W-2, you just have a regular job and you get a W-2 at the end of the year, there's probably 4 boxes of deductions that they've taken out of your paycheck for taxes. One of them is the federal income tax that we talked about. The other would be the state income tax that we talked about. There's 2 more that make up this FICA. It's Social Security tax, which any wage earner is going to pay 6.2%, and then Medicare, which they pay 1.45%.
1.45%.
Yep, for Medicare.
Okay.
And in addition to the employee paying that, the employer is also matching that amount. So you're actually paying, the combined rate for the FICA would be 15.3%.
It's huge.
It's getting paid into the Social Security Administration on your behalf. And when you get those green sheets at the end of actually I think they come right after your birthday or something, or right before your birthday, but it shows how much you've paid in towards FICA over your lifetime.
And Social Security, and these are taxed differently, because my understanding is Social Security is on a certain amount of money, but Medicare, Medicaid payments are on your total income.
Right. The number every year is adjusted for inflation. It's slightly over $100,000 that you pay Social Security tax on. So if you make $150,000, you're only paying Social Security tax on a little bit over $100,000, 102 or so. The Medicare tax, you'll pay all the way up through the $150,000 that you earned.
And one of the reasons, one of the politicians will always talk about trying to lift it and make people pay Social Security on their entire income.
Right.
But why is it capped? Why is it capped at a certain level?
But I would expect that it's based on how much you're going to be able to draw, because the Social Security is your retirement.
So it's not a welfare program. You've paid into like an insurance program.
It's like a retirement plan.
Retirement plan.
Right.
And you only get so much back.
Exactly. So when you receive retirement, your maximum retirement benefit is capped.
So if it ever came to the point where they took off the top and you had to pay on your entire income, they'd either have to give you Social Security payments when you're retired on your entire income, or they'd have to admit that this is now a welfare program.
Right.
Inheritance tax. We hear about is it called the death tax, or it's called, what is the other side call it?
I think we'd call it the estate tax.
Estate tax,
So,
okay. What's the deal with that tax?
well, that's making life miserable probably for a lot of estate planners, but right now it's at $2 million. So the first $2 million that a person might die with is exempt from tax. After that $2 million, I'm not sure of the tax rate, but I'm guessing it's somewhere in the 35 or 40%.
So pretty steep.
It's a high rate that you're taxed, an estate tax, and it's for people that die with a lot of wealth. Mm-hmm. One issue that I'm seeing now is a lot of people that are in their 50s, 60s have been investing a lot of money into 401k accounts, retirement plans, that in the past they used to be pension plans through a defined benefit, which is you just get paid until you die from your employer. Mm-hmm. Now they're transferable plans that people retain with them all through their lifetime. And in order to retire comfortably, you need a big dollar amount in these plans, $1 million, $2 million. So it's becoming less or more uncommon for people to have, it's easy for people to have $1 million or $2 million.
So more and more people are being hit with this ceiling of the inheritance tax.
Right.
Things.
In 2010, the exemption goes back to, I forget what year, to a historic year. I think it's back to maybe $1 million, or I think it might even be more like $650,000.
Yeah.
That you'll be taxed on.
Yeah. Well, I've heard too with small businesses, and not even small businesses necessarily, but family businesses, it doesn't take a lot to get $2 million worth of assets.
No, like family businesses, farms, any
farms.
of that.
And so if the farm gets transferred and the farm is valued at $2.5–3 million, which wouldn't be hard to do.
Right.
The people have to come up with 35% of that.
If the farm was worth $3 million, they'd pay the 35% on the million extra.
Over. Okay,
right.
So it's that much over. But
right.
Still, they'd have to come up with $350,000, right. And many farms can't do that. That gets us into, I think, it'd be time to go into the AMT tax.
Okay.
Okay, because this started out, how did that start out?
It started back, I think it was 1969, that it was to prevent wealthy people that had a lot of deductions from avoiding tax. Um, the AMT, actually,
Well,
the
it stands for what?
alternative minimum tax,
Alternative minimum tax, okay.
disallows a lot of deductions that you have in order to derive at your taxable income. So if, just to give you an example, if a single person had $40,000 of income and they had property taxes and state income taxes, those are deductions that aren't allowed for the alternative minimum tax. So while their taxable income might be $25,000 on that $40,000, their alternative minimum tax is probably the $40,000. So what the alternative minimum tax does is it requires you to calculate your tax, both the regular income tax and your alternative minimum tax.
And you pay the greater.
Right, and you pay whichever is greater. The alternative minimum tax rate is 26% for at the base level, and then 28% for high income earners.
Really?
Yeah.
Because I was reading that the top level for income tax is up to 35% for really top level people.
Right.
So how does that square with this 28% you're talking about with the AMT?
The 28% is more hitting the people in the 25% tax bracket, or the people that are actually that can get down to the 15% tax bracket for regular income tax purposes. But they're getting hit with 26% on their entire income. So the exemptions are around $46,000 for singles and $70,000 for a married couple. That's what you don't have to pay alternative minimum tax on.
So this is a tax that started out hitting only wealthy millionaires.
Right.
And because it wasn't pegged to inflation,
Right.
it's now hitting people who make $70,000.
They'd have to make a little bit more than 70, but 120,000 for a married couple, and 70,000
For
for
a
an
single.
individual could easily be hit with AMT. The deductions, the main things that you're looking for that probably aren't the deductions that a wealthy person are taking. Well, some of them are, but personal exemptions are probably phased out for most wealthy people, which would be you get a personal
That's
exemption.
$3,000.
It's around $3,400 per person. So if it's you, your wife, and 2 kids, you're getting that times 4, 3,400 times 4, so 13,000.
Okay, let's just define exemptions. Before we go any further. Yeah.
An exemption is what you don't have to pay. I suppose it might be for the cost of living of each person. You don't need to pay tax on that.
So you take your income, and you have a certain number of exemptions, and that, say your income is $100,000, you have exemptions that add up to because of your children and your mortgage payments. I think you can.
Exemptions
Yeah.
and deductions are 2 different things.
Okay.
The exemptions are for the people in your family.
Okay, so basically, if you had, 4 kids and you have $3,000 a kid, something like
Yep.
that, plus yourself and your wife.
Yep.
So you add that up times 6. That's
Right.
almost $20,000.
Right.
So you have $100,000. Now you're down. So you take that 20 right off the top.
Yep, right off the top.
So now now we're coming to you with $80,000 of income.
Right.
That you
That's-
find other things.
Right, and then you can take deductions, which if you take itemized deductions, then it's state income tax, mortgage interest, charitable contributions.
Those are deductions.
Those are deductions. Those are
Okay.
things that are called an itemized deduction. Also miscellaneous expenses, which might be investment fees or it might be employee business expenses. So like a salesperson.
Their car, travel,
Their car,
suits,
home
clothing.
office. So expense, trade journals, things like that would be expenses, employee business expenses that are deducted for regular income tax purposes. If you look at average family in Brattleboro, it might be their deductions are somewhere between $15,000 and $20,000. If you're looking at mortgage interest, somebody that has a mortgage, property taxes in Brattleboro are pretty high, state income taxes. So that $20,000 would actually come off the 80 and get you down to 60.
Oh, so it is direct, just like an exemption then.
Right, it comes right off with the exemption. So you're actually taxed more you might make 100, but for regular income tax purposes, you're probably taxed at 60.
Okay.
$60,000 for a married filing joint return would be taxed at 15%.
15%. So you're going to pay 15%
15% on the 60,000.
to the federal government.
Right.
And then we got the state coming in with a quarter of that again, more. So you
They
get,
actually put their own rates in, but it
Do
used
they?
to be a quarter. They have their own rates, but it's similar to, it's about a quarter.
okay. Our tax system is described as progressive. What does that mean?
We've talked about it a little bit just in the different tax rates. It ranges from, the federal income tax rates range from 10% up to 35%, depending on your income. And if, just for an example, if somebody made $30,000, they're actually probably in the 15% tax bracket.
Mm-hmm.
If somebody made $100,000, they're probably in the 25% tax bracket. But on the first $30,000, both of those individuals are going to pay the same amount of tax. It's
Oh, really? So you
those
can split
tax
it up.
rates are a marginal rate. So the first, wherever the break is in the rates, when they go from one rate to the next, you pay that amount of tax on your income,
So
that rate.
Yeah, so the $100,000 person is only paying 25% on the top $25,000,
Exactly.
something like that.
Right.
Well, that makes it easier to swallow.
Right. Yeah.
Yeah.
It's not like if you go over, I get people that come in and are worried about staying in the lower tax bracket. If you go over by $1, that dollar is what's being taxed at the higher rate, not
doesn't-
all of your income.
Okay,
So it's
that's
not,
more fair.
it's not like you have to really watch it to make sure you don't go over this cliff. It's not.
And the whole theory behind being progressive is to take more from people who, a higher
Right.
percentage from people who make more.
Right. The rate goes up as your income goes up.
But it also has a adverse effect, I would think, in that people try to stay below a certain number.
Right.
And so it can be counterproductive to having people produce more.
I suppose so. Yeah.
You know, you just don't work as hard, right?
Right. It could be counterproductive, but
It tends not to, I think, with human nature. You just,
if I were going to earn $1, and even if I can only keep 75 cents in my pocket, I'd rather have that 75 cents than
A
sit
piece
on
of
my
the pie.
couch and not have it.
yeah,
at all.
so it tends to do it. Now, let's jump from the individual here to corporations. You'll hear people say that corporations aren't taxed enough, or don't pay enough tax, or don't tax at all. What's going on with that?
I think some of it is just the training that we've gotten from politics and things, but I just saw an article that said 2/3 of corporations don't pay tax. In my business, we probably do 70 to 100 income or corporate tax returns. Probably 95% of those corporations don't pay any tax. And it's not that we're doing anything that other people aren't, it's that that's the way the system's actually designed.
Now, is that through deductions and so forth? You can get down they're only taxed on their profit, right?
They're only taxed on their profit, and only some corporations are actually taxed on their profit.
Wow, this sounds confusing.
So, if this time of year we're hearing a lot that the corporations don't pay enough tax. Probably about 65% of our corporations are considered to be a subchapter S corporation, which is a chapter in the IRS code that says that any income that they earned is not taxed to the corporation, but rather passed through to the shareholder. So the first 65% of corporations, or about 2/3, by design, are not going to pay tax. Their shareholders are going to pay tax. So if a company made $1 million and they were a subchapter S corporation, they're not going to pay any tax. If they have one shareholder, it's going to go on to the shareholder's tax return and
So
get taxed at 35% at the individual tax rates.
So the individual gets taxed.
The individual gets taxed for any subchapter S, any shareholders for any subchapter S corporations.
And it pays to do that because individuals get taxed at a lower rate. Our corporate tax in this country is the second highest in the world. I don't know who's number one, but we're at 35%.
Right.
So it pays for them to throw that to shareholders and therefore to the individual, their profits.
To some degree, but that's not even the real benefit.
Okay.
The piece that they're looking at, the other 35% of corporations that aren't S corporations are just your traditional corporation. They actually pay tax. But even those corporations, at the end of the year when you're doing tax planning with them, you don't want money to sit in the corporation. So most of it's paid out in bonuses to the individuals, and they get taxed on payroll taxes because it's a check to them,
Income.
it's a payroll check to them, and they get taxed on their individual income tax return on that income. So when I'm working with a client, we're trying to get it as low as possible, the corporate income tax. Not so that they don't pay tax, but they don't pay tax within the corporation. They pay tax at the individual level.
Because it's less. It's a lower
No,
level.
the rates are similar.
They are.
Yeah,
Okay. I'm not following
the
this.
top money that's not paid out in salary within a corporation is paid out as a dividend,
Right.
and that's taxed to the individual.
Right.
It's not deducted by the corporation. So if I made $100,000 in a corporation, and I had 4 shareholders, and I paid them all $25,000 in dividends, the corporation is taxed on $100,000, and then each individual is taxed on $25,000. So you're taxing that $100,000 twice. So that's the reason why corporations don't keep the tax in the business.
And throw it.
But
They throw it.
because anytime it's passed through to the shareholder, it's taxed to both corporation and shareholder.
Okay, and so basically when you were throwing this, I was thinking this money's getting taxed twice, and nobody wants to be taxed twice on that same amount of money.
Right.
Because then it's really huge.
Right.
So there are systems to get around it. So you really can't, and we can't blame corporations or people from using your expertise to find out how to pay the least amount of tax, because that's how the system's set up. If you
Right,
don't
and
like it, change the system.
I think the people that set the system up set it up so that corporations don't retain that, and that they are paying their profits out. One argument against the corporate tax is if you're taxing corporations at 35%, then they need to recoup that in order to stay in business, and they're going to increase the price of their products.
Well, that's what we've heard. You know, if you tax different things, they basically consider that a cost of doing business,
Right.
and pass on the money to us, and our prices for things go up.
If you tax it to the individual, it's already come out of the corporation, and they aren't raising their prices.
We can't raise our price for just being here, can we? We
No,
can't say I'm worth more now, so pay
Right.
me. So
Exactly.
okay, so that makes more sense. Okay, it's a confusing situation. I know we've talked a little bit about how tax starts and grows and envelops more people, and that always happens. You also mentioned one of our big things that is adjusted is property tax, which we haven't talked about at all here. But you can take that off as a deduction
Right.
on your income. So basically that makes your property tax a little bit less draconian. You're basically saving a third of it or something like that, or
It depends on your tax
Depends on
rate,
your
but you're
tax rate.
saving it both federal and state.
at state level. But now Act 60 changed how our taxes are going. You mentioned you wanted to speak to that a little bit. How do you see that influencing your tax preparation?
Well, it has made it a lot more complicated, especially this year. They've suddenly decided that they're going to pay the tax payments directly to the towns. It's a great idea, and it makes sure that the money is actually being spent on property taxes. The downside of it is the tax bills are created in June or July by the towns, when I just filed a whole bunch of returns on October 15th. So all those people that filed a return, the state needed estimated forms back on April 15th to kind of give a guess on what they should pay to the towns. And now, when they actually filed in October, they revised that guess, and now if you didn't get as much of a credit as you thought you were going to, you have to pay it back to the state. Your tax bill does stay the same, but now you owe the state for money that they already paid on your behalf to the town, along with interest and penalties.
Along with interest and
Along with
penalties,
interest
even though
and
you
penalties.
had nothing to do with generating that time lapse.
If you estimated your income too low, then that would have, so when you're filing that estimate, make sure that you file it with way more income than you expect.
Get it up there, so you get a
Right, so that they won't send as much to this town, and then they'll send it to the town later. And the other tough thing with Act 60, that just preparing a couple hundred tax returns every year and seeing all these adjustments, is they haven't taken into account the source of the income. So, and I say this because if a person had a job and was making $40,000 a year, they would get the same tax refund as if somebody was earning $40,000 a year on their bank account in interest. So I assume that the person making $40,000 in interest probably has the means to pay their property taxes.
Right.
Whereas
the poor guy making 40,000 is struggling.
The guy, right, and then the family making 100,000, both two wage earners, aren't going to get anything.
Aren't going to get anything.
But what they need to do is they need to look at the sources of income, and passive income, which is things that you're making that you aren't working for, probably mean that you have some sort of wealth behind it.
And so why are you getting a break?
Why are you getting a break if you have the means to?
I think that's huge in Vermont, because we always hear about, people talking about the coupon clippers and trust fund babies and hiding their money in certain ways and not paying taxes, and yet taking advantage of our tax system.
Most of the property tax adjustments are going to those people.
Most of them are going to those people.
They used to be capped at $10,000 of property taxes. If you pay property taxes of $10,000 in Brattleboro, you're owning a $400,000 to $500,000 home. There's a few examples that we're allowing somebody to stay in that $400,000 or $500,000 home. Most examples, they can probably afford to stay in that $400,000 or $500,000 home, and we're just paying a large amount of their property taxes.
So we're subsidizing wealthy people through this system.
Wealthy people that don't have a lot of earned income.
They don't have a lot of earned income, which is really interesting in that our politicians rile against that. And yet this whole system, and you're saying majority are fitting into this. We've suspected this as you hear people talk.
If I added up the property tax adjustments for the people that I've done their taxes on, the majority of it would go. Somebody making $100,000, the family size doesn't matter either, because it's based on how much of income. But two wage earners making $80,000 to $100,000
are subsidizing people who are having trust funds.
They aren't getting
any break.
Any break. They might get $100 off their property taxes. Making $40,000, you're probably going to get $2,000 or $3,000 off a small home. If you own a $400,000, $500,000 home, you're going to be getting $6,000, $7,000, $8,000.
Wow. Wow. That's really interesting. I don't think most of us know that.
Right.
That's how that works.
Well, hopefully somebody will do something about it.
Well, I hope they will find out about it, because that's really, I've heard that some of the biggest refunders are people who have huge trust funds, and they get a huge refund back.
Right.
Yeah. I have to pause here because it makes it's kind of like you would think that the people who designed this know enough that this would be a consequence, and probably
They either know it or they fit into it.
Exactly, and it's self-serving. Steve, I think we're at the end of our time.
Sounds great.
Okay.
Thanks for having me.
Thank you for coming. And I think this has been very informative. We'd like to thank our sponsors, Wyndham World Affairs Council, Stacy Subaru, and Media Room Productions. Thank you, and have a good day.